Hey everybody, it's Marcus. Thanks for joining me again for this next installment of The Wide World of Real Estate. Today I've been thinking a bit about how real estate investment in the capital markets of bonds and common stock has a relationship to that of real estate investment. And I'll just be honest, I've embarked on learning about the capital markets recently, and it is something that I've never taken part in, just because a non-collateralized asset never made tangible sense to me. Yet I know the world of savings also includes diversifying your portfolio, and that's what I'm aiming to do over the next period of time, is to, as I go into my 50s, I will be interested in probably getting away from day-to-day management of real estate and into more passive type things, which I think you can do in my experience, much lower returns, but a higher rate of being liquid and more passive returns. And it's my understanding that you can, if you do well in an index fund, you can kind of expect a 5% return if you don't mess it up. If you go out and try to pick winners and think that listen to gurus, then you are probably making a mistake, because a good index fund is probably going to create the vehicle that you need in your life if you're just looking to compound an earning over a period of time, and probably dollar cost index, meaning put an amount of money from your wages toward that aim. And where do you go for where are your resources for understanding the capital markets? Well, the most prominent guy out there is, of course, Warren Buffett. His fund, Berkshire Hathaway, is wildly successful as a money manager or an index fund. People let him put money in the hands of a skilled person for a return, and he has absolutely done that over the 40 years that he's been investing, or maybe more. The guy's getting on up there, right? So I thought I would listen to him, and he references a book by Benjamin Graham, right? Benjamin Graham wrote The Intelligent Investor, who ran a fund, or a private investment fund, and created a paradigm, created a structure for how to invest. And that's what I want to share. I want to kind of contrast the principles in The Intelligent Investor, compare it to my understanding of real estate investment and my learning over the years. It's what I participated in. So I guess I am a data point. I wouldn't call myself an authority, but I would call myself a data point, a person that filters information and makes lateral connections, and how you might think of it in your own personal life. And I just encourage you to embrace what you can control. Maybe say the serenity prayer to yourself about what you can control and what you can't, and having the wisdom to know the difference. And I think that I'd like to start off with a small little snippet from what Henry David Thoreau he said in one of his I guess philosophical writings. He said, it's easy in the world to live after the world's opinion. It's easy in solitude to live after our own. But the great man is he who, in the midst of the crowd, keeps with perfect sweetness and independence of solitude. So if you can still be yourself, even though there's a world that wants to influence your actions and your thoughts, that's the great man that can still be themselves in the midst of this, all these data points, all the talking heads telling you what to do. And I'll just share with you my jaundiced bias is that anything behind a paywall, anybody who stands to gain, it has a certain bias. Regardless of everything, you are buying into that person's bias, and with multiple data points behind people out there making money for clicks or services, you really just have to make up your own mind. Whether you invest in Warren Buffett's index fund, whether you pick the stocks or choose the real estate yourself, making up your own mind, I think, is the key, and educating yourself has been how I have succeeded on a small scale, and enjoyed independence throughout my life. So let's wade into a little bit about what I'm talking about, and that is the intelligent investor. Graham Bell, let me see if I can get to where I want to be. Graham Bell was from the 70s, and he really has a broad view and a long view. His book has filtered and connected points from a type of almanac, and consults several reference points for the book that he wrote in the 70s. And if you get a hold of one of these books, then it's going to have an update by somebody who has studied this book and used it and updated it for the modern times. And a brief synopsis of its main ideas is to really make a distinction whether you're an investor or a speculator. This definitely applies to real estate. I will just state that the people that are wholesaling, people that are fixing and retailing property, I view them as speculators. It is a little bit about gambling. They are timing the market, and people that pick common stocks that are doing well, they're also market timers. Warren Buffett says that he can tell you what's going to happen to a market, he just can't tell you when. And one major distinction between real estate is that it tends to move a lot slower. It is definitely illiquid. You can't just automatically push a button and get your money out of it. It's going to require some research, maybe physical actions to be taking place, like improvements on the property. But the markets, I think, they move slower. They don't react quite as quickly to the news cycles, and they have intrinsic value. So that is one very distinct way that they are different. However, you can call yourself an investor in real estate if you're not worried about the timing cycles. If you're going to hold property for a long time, I would consider you a real estate investor. But I think that you have to understand the inherent risk of getting in and out of a property or a stock in short order. I would call that within 12 months, because you have there's going to be commissions, there's going to be tax implications, short-term capital gains being one of the major ones, which, in some cases it can really eat into your profits. And Benjamin Graham talks about the commissions involved to erase whatever profit you might achieve just because of the tax implications, as well as the commissions from stockbrokers or the experts. I have a previous oratory in one of my previous episodes about the experts. When I would encourage you to, take the fact that someone calls themselves an expert with a grain of salt, because in stocks and in many decisions in forecasting, the type of experts that are out there bringing attention to themselves as the expert and having a real clear message about their greatness, they don't do so well on forecasting things. That's what my previous episode was on. So you really have to understand whether you are a speculator, which has an increased amount of risk and an increased amount of tax burdens, I'll call it, because getting in and out costs more. That's my opinion. Holding a stock for the long term, holding a property for the long term, I feel like you kind of have to just accept the ups and downs of the market as far as owning that stock or real estate or bond. Bonds are different because some are non-taxed, and there again, this is part of my understanding and my learning is that some municipal bonds are not taxed, and that depends on the interest rate of the day. And another way, so decide if you are an investor or a speculator. If you're a speculator, I believe you have to understand that perceived profit or gain, it could be real or it could change fairly quickly. Secondly, is to maintain a margin of safety. So I'll just talk about the bond markets. He says you really want to be of the understanding that there's enough meat on the bone to cover you for any losses or changes in the market, as well as in real estate. The heuristic, the rule of thumb is that you make the deal when you buy it, not when you sell. So you're building in that margin of safety for your purchase. If you hold on to a property or a stock for a long time, that's just going to smooth out as you pay down. I'm going to assume that there's going to be debt. You're going to pay down the debt, and a lot of things are going to solve themselves over time. Somebody that buys something 20 years ago and the property goes up at 5% compounded over the years, or even 3 and 4% over the years, they're going to pay it off, and they're going to have a free and clear property. The property's going to appreciate, and they're going to look like a genius. So if you want to look like a genius, just buy property at market rate and then wait 20 years, and you look smart. And I suspect, even though I haven't done much of any stock investing, I suspect that holding things for a long time, like Warren Buffett, he expects to be in his purchases of companies. He views them as viewing his purchase of stock, preferred and common, as a purchase into the business. And he stays there for a long time and looks for good management. You can be defensive or an enterprising investor, and depending on what kind of appreciation or valuation you're going to pursue. And one of the main, you can pursue stocks that pay dividends, but whenever we talk about dividends, real estate dividends is what everybody is looking for. You might call it positive cash flow. Each month you're going to be gaining a dividend. So if you're interested in that kind of paradigm, not just growth over time that you can sell at a later date or borrow against at some point, then you should probably look for dividend stocks. I don't know enough to talk about what's a dividend stock and not. And just due diligence. It seemed like you really need to be in the business of evaluating companies if you are an investor in the capital markets or stock markets, and make a decision or create your principles for investing in property. So that is how you would evaluate stocks, is determine what the assets that are owned by the company versus the liabilities. And there again, the stock market, in my opinion, has professional financial types that go to college, that all look at the same thing that everybody else does, and just a higher level of competition that you have zero control over, other than to stick your money in it or take your money out of it. Those are the choices that you have with a bond or a stock. You don't get to help manage. You're at the mercy of the manager or the company, or the manager and the company, and perhaps another layer of your stockbroker that's giving you advice about what to do. Meanwhile, in real estate, you can do something in addition to it being similar to a dividend stock, except for the liquidity and I guess tax implications. You have the power to influence your investment, and one of the main ways is that you can improve the property or add value. I'm sure you're well aware of something in the residential field to upgrade the interiors or renovate the kitchens and bathrooms or fixtures, landscaping. For multifamily or commercial properties, you could improve the common areas, the security systems, and other common amenities. You can increase value by increasing the rent. You can increase your dividends by reducing your operating expenses, like your management process, your vendor contracts. You can even implement cost savings measures like energy saving solutions. That can all increase your net operating income and thereby adding value to your property. On real estate, you can change the property's use. You can repurpose it and change the value again. Let's say you convert a single family home into a multi-family residence, or transform a warehouse into some loft apartments, and just tap into different demand segments in the market. With the real estate, unlike stock, you can apply for zoning changes and land use changes that might add value. Like if a piece of land is zoned for agricultural use, it gets rezoned for commercial or residential, that market value can jump substantially. Developing raw land into subdivisions, that is a major way that large funds go scale their valuation. If some, I don't know, I'm just going to guess, a teachers union or an automakers union has a pension fund that they want to go out and grow, they put it with these funds that go out and add value to a piece of land by building streets and putting infrastructure for home building, and then sell it to large home builders, developed land. That absolutely adds value. I know you can finance stocks with, I don't even know what to call them. Forgive my ignorance in the bond market, but I know you can finance it. But that just inherently seems like a risky business, because what are we dealing with? Something without intrinsic value. If a house value goes all the way to zero, at least you can go live in it, and therefore establish intrinsic value. I'm, of course, exaggerating that scenario, but if I were to get a loan on a bunch of paper stocks, I would consider it very risky. But I don't know how people rate risk in the capital markets. One with real estate, enhancing the value with refinancing at lower rates can reduce those monthly payments, and also development and expansion, adding more units to a multifamily property or expanding the square footage, developing unused sections of a parcel of land, like whenever you see these shopping malls allow a pizza shop or a GameStop out on the periphery. You'll see it in markets, in these large department stores with these pad sites, I believe they're called. They allow drive-in restaurants or coffee shops to buy or lease a parcel on the roadside or perimeter of their parking lots, and they can develop an existing parcel of land. And a leasing management company for commercial properties, securing long-term leases with excellent credit companies, corporations. If you get a long-term lease with a big-time company, you're going to add value to your property and your stock, as it were. And last thing with real estate, market timing. Again, this is risky, and if you're investing for the long term, it is not going to be something you're going to try and do. But going around and doing a little forecasting on growth areas, growth trends, or properties that are in transition for whatever reason, hopefully toward the top end, selling if it's going down and buying in if it's going up. But adding value is a dynamic of real estate that is not achievable in the capital markets. So a couple of things that offer those the tax benefits. One thing you don't have with bonds that you have in real estate is the ability to depreciate improvements and to expense capital improvements as well. So that's another way to cut your tax burden down on the dividends and rent that you would income that you'll receive from real estate, whether it be any type, really, income producing real estate. We don't do that in stuff that you live in, but you do have expense and depreciation as your tools to cut into your tax burden. So another way that I feel like the tangible asset of real estate definitely has merit, and this has allowed me to contrast and consider what value that the capital markets and bond markets hold for people who are investors. And I feel like it's broadening my understanding of investment, even though I haven't participated in it. This has allowed me to contrast with municipal bonds. Those are sometimes tax-free. Savings bonds, college savings plans, these are money markets that you can invest in, and there's even a mode to self-direct these things, your Roth IRAs, and have a self-directed 401k. And by the way, you can buy real estate with those, but some people take those accounts, those tax-free environments, to invest into index funds or bonds or common stock. This is another way to help yourself on the tax burden for these type of investments. Not all bonds are completely tax-free, but how would you value a stock if you were in the mood for putting money into the stock or bond markets? How would you value it? Well, you have to determine the company's shareholder equity, and that is the shareholder equity is the total assets minus your total liabilities. And now we're getting into analyzing businesses, analyzing the company that you're going to invest in over the long haul. So that's the way you figure out your own net worth, is your assets minus your liabilities. That illustrates your personal net worth, and that's what you do to stocks. So you're also encouraged by Mr. Graham to determine the number of outstanding shares, the number of shares that are held by all the shareholders, and you can find this on the government's. There's a government site that shows how many shares there are, and then calculating the book value for shares. So that is the book value per share, which is the shareholder equity divided by the number of outstanding shares. So if a company had shareholder equity of 100 million and there are 10 million shares outstanding, the book value per share would be $10. So now that's how you build in to see what it's currently trading at versus how much the book value per share is. If there hasn't been any goofy stock buybacks or stock splits, these are maneuvers that companies do to. I'm just going to say that that I'm ignorant of many facts regarding, but I'm just going to tell you that it seems like that is what Benjamin Graham recommends to figure out what the book value per share is, and then see what it's currently trading at. So it is a multiple of what the company earns, and different industries have different asset structures, and ideally this valuation should be compared on stuff in the same sector to get a comprehensive view of the company's health and their valuation. So when it comes to real estate, what do we have to evaluate real estate? Well, what we have in real estate is really the cash flow analysis, and that's an estimate of the monthly income the property can generate, and then subtract all the anticipated expenses, like the debt, like the taxes, like the insurance, like the maintenance, PITI, and then management, and then maintenance, and then calculate the return on the investment. So calculate the return you expect from property as a percentage of its cost, and then consider both the rental income and the capital appreciation. So you got something that looks at the day-to-day, what's your rent, what's your expenses, then you can make a calculation there, and then you can make some projections, maybe some trend lines about what it's done. Well, you're probably going to need some pretty detailed information about valuation, the 5-year appreciation, and I suspect you'll need access to some market information from an assessor, from a realtor, from a different source that has the sales. That's what we have to determine valuation. And you can get a capitalization rate. If you are looking at real estate, you're going to be very impressed about how realtors can figure out the valuation by the cap rate. So if you want a 10% cap rate and a property throws out $10,000 a month, your cap rate is 10. So you'll in this world of increased appreciation, people are investing in properties with cap rates that have had a good amount of pressure on it. So they've been kind of trending downward. And then you can figure your cash on cash return with your positive cash flow versus what you had to put out to get into the property. And that would be your actual cash invested. It could be improvements too. We got to include that. And we got to divide the annual pre-tax cash flow by your total cash investment. And that includes your down payment, your closing costs, as well as your renovation costs, anything that it costs to get that property up and running. And you really have to get a true measure. If you're going to be investing for the long haul, we got to talk about your total cost of acquisition, purchase, closing, renovation, and then just for talking purposes, we got to compare these different asset classes and different properties to one another. We really need to understand how many years it's going to take us to recoup the investment based on net cash flow. So that's running a property like a business to determine your cash on cash return. I don't know that you do that with dividend stocks, because that's only part of the reason people buy these blue chip stocks and dividend stocks, because they're going to increasingly put their wages, their commissions, or their fees, their income, they're going to just put a portion into it and have a compounding feature and a dividend feature of that stock. And I haven't come across any literature that talk about a cash on cash return from the money that you invest in a dividend stock. I just haven't heard that. So when we're talking about prices to offer for property, you can certainly talk about the cash flow, the financials of the property, the capitalization rate, the expenses, and the financing. But the actual value, the comparative value, we would look at a market analysis. You compare it to similar properties. You can look at the rental rates to make sure that you can verify that you have the correct numbers before to put into your cap rate and your figures for that. And we can look at market trends. If you figure you're going to start being a forecaster and somebody that reads the tea leaves for which way a market is going. But there again, deciding the causal factors that are going to be indicate a result. There's precious few causal factors that are going to ultimately decide the fate of what happens to a market in a given time. When you analyze your property, again, this is a departure from the capital markets. You have the physical inspection. You can hire an inspector and inspect it yourself to uncover any potential issues, to make sure that your collateral and your property you're investing in is in decent shape. And before you buy, you can inspect for structural damage or roofing or wiring or plumbing, etc. And you can anticipate with the age of a property that the maintenance is going to be more on older properties. That's just seems the way it goes. Just like maintenance on an old car is more. And you can inspect the layout and feature to determine if it's going to be marketable. You can analyze the neighborhood, the economic factors of an area. You can get demographics pretty easily just to recognize trends and establish value. With a piece of real estate, you can analyze your risk. Macroeconomic factors like recessions or employment in the region. You can determine with a price to rent ratio whether or not you're going to have competition from people going and buying. If it's cheaper to buy than it is to rent, then you're gonna face competition from the market of properties that are going to be for sale. There are specific property risk, costly repairs, or mold or pests or foundational damage. Management is going to be an issue for you in holding real estate, and how you're going to adapt to challenges or the needs of management, keeping your place rented, improving the rents over time. And there's tenant risk, there's liability, rental defaults, or property damage. It's just going to happen. We're going to have increased legal and regulatory analysis for holding real estate, zoning laws. Demand can keep you down with rent control. Some cities have rent control regulations that might limit your rental income. And there's legal liabilities, like I said, like the slip and falls, the lead paint, this human quantity. Well, I don't even know if I want to say it. This human aspect of real estate definitely can affect the financials if there's a screw up or there's a job done right or excelled upon with the management or financing or these. I guess I really don't know how to say it other than to say these human resource type aspects of real estate, because honestly it's gonna hinge on relationships. Whether as a capital market, I think it is much less a human issue. So we really need to do a financial analysis. You can understand how your mortgage terms are going to affect your actual cash on cash return. That is absolutely going to affect it. And if you're in something for a long haul, then it's going to be less of an issue. But we're going to have exit strategy analysis. How might you get out, and how long might you want to hold it? Are you going to want to do estate planning with this piece of real estate? These are all implications that as far as an exit strategy. And the tax implications. You are going to, again, have the tools at your disposal of depreciation and expenses in real estate. This does not appear in the capital markets. So are there ways to determine if you're going to be able to build in that margin of safety that Benjamin Graham talked about? Well, I suppose there are ways you can talk about what you feel the value is versus what you offer and get an offer accepted as. You can see in the capital markets, you can see what your valuation of the stock is versus what it's trading at. Another one for real estate would be, what is the loan constant? It's the loan constant allows investors to real quickly compare the different loan options. Two loans might have the same interest rate, but varying terms or fees that might result in different loan constants. The loan constant shouldn't be your sole metric when evaluating real estate financing. You need to also consider your prepayment penalties and your loan flexibility. So the loan constant, the cap rate, the cash on cash return, these are valuable tools. Another one is net present value. While I'm on it, you really need to understand the time value of money, and that is a real crucial skill to have, is to understand the time value of money, and few people do. And that is interest, principal, and compounding interest, and discount rates. I'll just try to make a quick example. Whenever you pay $100,000 for a house and you get a 30-year loan at 6%, you're not just going to pay $100,000 for that. You're going to pay probably 3 times that much at the end of 30 years. So if you've got $300,000 in 30 years, if you discount it back 6%, if you wanted to buy $300,000 in the future and you wanted 6% on your money, for this incorrect example, you'd pay $100,000 today. That would be your discounted rate to get $300,000 in the future. And that is if you wanted 6% on your money. So these are just a few of these to consider whether or not you want to play in the capital market with bonds, common stock, preferred stock, or dividend stock, or if you want to get real estate that has the potential where you have a very large potential to influence your dividends and to enter into the world of these human resources, these relationships with your tenants, tradesmen, service providers, salesmen, and these type of things where you'll have direct contact with somebody to help you with your real estate. So this is kind of what I have with regard to comparing and contrasting these two asset classes. Another asset class, if you're interested in multiplying your money, might be the purchase of business. I have not considered that at all, but I do understand it as yet another asset class if you do want to take the money you have and invest it in something to get some derivative of money that you have to work, or you're trying to get out of the business of trading time for money. It is one other way to multiply your money. So, all right, well, I'm going to sign off for now. I'm going to tell you that I've created in my knowledge base on that Notion template, I just added it. It's under RE Education. If you go to simplifiedhomesales.com, you make a free Notion account for yourself. You go to simplifiedhomesales.com and click that top right button about my ultimate real estate template. I'm putting all this on there. You are welcome to it. It's free. If you have a question on any of these things after you copy it into your own Notion account, you can find @MarcusTuttle and add me to it. And I pretty much live inside of Notion for my management of my life and my business. So I'll be able to answer your questions just like that. I would be invited as a guest in a very small portion of your Notion account, and I would not have access to all of your stuff. I would only be a guest, and it doesn't cost any money. So that's what I have for you this week. I hope I've shed some insight, and I can't stress enough to make up your own mind. Educate yourself and make up your own mind. There are 100 people a fingertip away that are going to vie for your attention and your clicks and your money, but just determining your own style will most probably leave you with the most contentedness, most content feeling and positive feelings for your money. All right, well, again, Marcus Tuttle here. Thank you for listening yet again, and utilize the tools. That's what I'm making them for, and I will hope to see you next time. Bye.